This is Bloomberg Intelligence.
Spotify have always had fantastic user momentum.
Solar energy, the fastest growing corner of the energy market by far.
In-depth research and data on 2,000 companies and 130 industries.
The talent wars are right around Wall Street, but the buy side is plucking off of the sell side.
Aldi was the fastest growing grocery chain in the United States last year.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
We're going to dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we're going to take a look at the EV space. Companies are just churning out models faster than we can actually buy them. So when's EV demand going to actually line up with supply?
Plus, we learn how a sales slump for software makers might be related to regional bank turmoil.
But first, we're going to take a look ahead to the first quarter earnings season over in Europe with Bloomberg Intelligence senior equity strategist Laurent Douillet. All right, we're going to pick up a lot of steam next week. We're approaching it. We got the big banks coming in. What are going to be some of the themes that you're watching?
I think there are four big themes. The first one, if you look at the overall picture, we have a decline of about 1% in terms of EPS growth in the first quarter, but there are significant divergence between sectors. For example, we have financials and technology where earnings are expected to increase by at least 20%. And on the other side, you have the commodity sectors where we should see double-digit EPS fall. In terms of big theme, within financials, there will be more scrutiny on the stickiness of bank deposit and also what is the exposure of European banks to the CRE market. Overall, European banks have more the structure of a JP Morgan and Bank of America rather than a Goldman Sachs. So overall, we should expect European banks to have a good quarter. Another theme is going to be margin resilience because sales have decelerated significantly from double-digit growth rate in the second half of last year to about 4-5% in the first quarter, and wage inflation remains well above that level. So we need to see if companies will be able to push higher prices in order to offset costs, and so companies which have pricing power or good product cycle, I think, will outperform. And the last point is definitely we need more visibility and guidance for the remaining of the year. I think overall the first quarter are likely to come better than expected because we had good macro numbers compared to previous expectation at the beginning of the year. But European companies are going to face tough earning comparison in the second and third quarter, where the earning growth was in excess of 20%. So definitely the earnings picture is going to deteriorate in 2Q and 3Q. So if we get more good visibility from companies, I think it will be reassuring for investors.
So, Laurent, I think what investors are trying to get a sense here of is earnings risk. We know kind of the central banks, kind of what they're up to, but earnings risk is still a little bit of a wild card. How much earnings risk do you see in the European market broadly defined?
I think definitely there are risks at two levels. First, in terms of numbers, I think the market consensus may still be a bit too high compared to what we have in our model. And second, when you look at valuation, I think also a lot of companies' valuation do not yet discount an earnings recession in 2023. So I think there is a double risk where one, earnings could be lower, and second, we could see a derating on some of the companies which are going to warn.
But does it in that, and I just take a look at, say, luxury, for example, that's huge exposure to China. You can make an argument that like having 52-week high after 52-week high and the valuation should be there. How do we know what's like the best? How do you then look at the valuation picture overall?
I would say for the companies in the luxury space, I think the re-rating that we have seen for these companies is being justified because they have the pricing power. New generations are really keen on luxury and beauty products. So these companies, they have been able to raise prices without impacting their volumes. So they are going to deliver higher operating margin and higher return on equity. So I think just that should justify a re-rating of those companies. But after the strong run they had in the first quarter of the year, I think at this point they are fairly priced. When you look at other part of the European market, I think the cyclical deep value companies in energy or in banks or in autos are still trading at significant discount to their fair value. So I think on this part of the market, I think there are still some good buy opportunities.
I'm excited. Any chance to talk more about Hermes bags, and I'm totally into it. Laurent Douillet, thanks a lot. Really appreciate it. Bloomberg Intelligence Senior Equity Strategist.
Sticking with first quarter earnings, analysts expect it to be an ugly one for the S&P 500 companies. For sectors looking at net income in the red, how close are we to the bottom? For more, we bring in Bloomberg Intelligence Chief Equity Strategist Gina Martin Adams. So, Gina, you've been talking about a rough patch in earnings, for the S&P. I guess kind of this is it. How tough do you expect this first quarter to be for these companies?
Yeah, well, the analyst consensus actually expects the bad news is this will be the worst quarter of the economic recession. Earnings are expected to fall 8% year over year in the first quarter. The good news is also, though, that it is the worst quarter. So things are supposed to get slightly better from here with second quarter earnings of down roughly 6% year over year, and then maybe earnings recovery emerging in the second half as comps get a lot easier and margins stabilize and start to potentially improve later this year.
Okay, I have like 17 questions related to this. One, yes, earnings are supposed to be lower. Sentiment was really bad, yet equities keep holding in. Have you already priced in these bad numbers and are looking forward, or are we going to see some kind of really big realization happen to this market and baby gets washed out with the bathwater?
Yeah, so our work actually suggested we priced in a pretty material earnings recession as early as September of last year.
Hence the October low kind of thing.
Yeah, So then the market made its low in October. Analyst estimate revision actually made its low by December. Most of our work would suggest that we've already priced, really difficult economic and earnings conditions to come. The question then becomes, could we have not potentially priced quite enough? And I would say the answer is, the old saying, the proof is in the pudding. The answer is, well, we've at least priced as much as analysts are forecasting, because at the start of this year, analysts were anticipating a mere 2% decline in earnings for the first quarter. And as you can see, now we're at 8%. It's done nothing to deplete the optimism in the equity market as stocks has sort of shrugged that off. So I would say that the big risk is really into late 2023 and 2024. Analysts have been marking down their expectations for the first half, but those second half expectations have held up pretty well, and 2024 expectations have held up pretty well. So the market was anticipating weakness near term, but is the market anticipating weakness all the way into 2024? No. So we want to watch that forward estimate revision numbers pretty carefully.
Gina, you've been so good in flagging for us and our listeners, and early, I might add, the margin risk out there in the marketplace. Where are we in that margin deterioration story, and when could it possibly turn the other way?
Yeah. This, to me, is just still very underappreciated, that margins were a very good leading indicator of this weakness to come. Margins peaked all the way back in 2021 on an ex-energy basis, and with energy peaked in 2022. The consensus is actually saying that margins will bottom in the first half of 2023, driving that recovery. And I think there's a lot of economic evidence to suggest that may indeed be the case. We follow the consumer price index and the producer price index and, a bunch of nerdy economic indicators, but the sum total of those is, for the first time in quite some time, consumer prices are rising faster than producer prices, which is historically quite a good indicator of margins for the corporate sector. If that proves to be the case, as it has in the past, consensus is probably right, and margins may find their bottom by the middle of 2023 and improve into 2024. That should lead the earnings trend into better condition come 2024.
Based on all of this, if a stock beats, do they see upside? If the stock misses, do they see really big downside? And I appreciate that this might seem like a really silly question, but it feels like sometimes the stock reaction is not what we're expecting.
Yeah, I think it's a very good question, because you're absolutely right. The stock price reaction, particularly during earnings season, is
it's just a game, right? Under promise, over deliver.
Yeah. A lot of it, frankly, Alex, I think depends not on the beat or miss, but on the nuances about the outlook, on the nuances of where the beat or miss came from, on the different sectors that stocks are in. Some companies trade on top line, some companies trade on margins. I think a lot of it is really in the nuance and the company specifics. But generally, I think a couple of things are really important to watch. It probably won't be about the near-term beat or miss, but it will be about the forward outlook. I alluded to the idea that the market's really well prepared for short-term weakness. What it's not prepared for is a company saying, hey, guess what? Things are not going to get better even into the latter half of this year. That could really deplete some optimism, particularly if they're saying that with respect to margins in some sectors where margins are showing signs of potential bottoming. The other thing I think could really deplete some optimism is on the top line. Remember, a lot of this weakness in the earnings stream has really been driven by that margin weakness. If companies really, start to guide much, much lower on top-line expectations, again, that could dampen the outlook for some stocks and sectors, and particularly like those growth-sensitive groups in the market.
All right, Gina, thanks a lot. Really appreciate Gina Martin Adams, Bloomberg Intelligence Chief Equity Strategist.
Coming up on the program, we check in on the EV sector.
You are listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us Saturdays at noon Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
EV makers are churning out cars faster than consumers want to buy them. Tesla already cut prices, and companies like Lucid and Rivian are losing money for each EV they sell. So when will demand for EVs line up with the ramped-up supply? Let's bring in Bloomberg Intelligence senior analyst Kevin Tynan. Kevin, this seems way early to have a supply-demand imbalance here. What's going on out there in terms of the demand for EVs?
Yeah, I mean, it really does seem, you would think that from what you heard about, backlogs and pre-orders that, that these sort of nascent pure-play EV companies would still be working through that. And to think that deliveries are falling far short of production this early in the process is a little bit alarming. And when you think about what that does, to cash on the balance sheet and free cash flow, in some cases is extremely troubling.
So what accounts for it? I mean, it's easy to look at like a Rivian or a Lucid. They're smaller companies. They're not the big guys like a GM or a Ford. What do we blame for this?
Well, look, the industry, even with the newness of EVs, is still very cyclical. And we've gone through a very long extended period of low interest rates. And even though prices were going higher, money was reasonably cheap and easy. And you get a little bit of an exhausted consumer. There's still uncertainty about, really the organic demand profile of a new technology. And when you look at even Tesla, this is really their first potential recession, right? If we get something in the back half of this year, so this is the first time through these things. And unfortunately for companies like Rivian and Lucid, it's coming at a very inopportune time where you have, the macroeconomic picture really slowing down exactly at the time where they need to be ramping production.
So what I know from reading your research and talking to you is you need that production, you need that scale. Where are these companies like a Rivian, like a Lucid, and maybe even Tesla in terms of where do they need to get to, do you think, to get break even on a per unit basis?
Well, Rivian and Lucid are a long ways away. And part of the problem with that, Paul, is that, what we saw in the most recent quarter is that, you're spreading or multiplying your cost of goods by the numbers of units you're trying to produce or that you do produce. The problem is you're only collecting revenue on the ones that you can deliver. So when you have this big gap between what is produced and what is delivered, your cost of goods is disproportionately high relative to your revenue per unit. And that's where these companies are right now. So, I mean, we're talking about, in the case of Lucid, 4,300 deliveries in all of last year. I mean, that's a long way away. And even the 20,000 at Rivian, and about half of those, in my estimation, or a little bit more than half of those are are delivery vans to Amazon. So when you think about full-scale global automakers, you're talking millions of vehicles. In the case of Toyota and Volkswagen, 10 million vehicles, and we're still in, five figures or four figures in some cases. So it's a long way to go, and it's not the best environment to get there in.
Do you think that Ford and GM eventually are going to have a better time? I take us back a few years. Time has no meaning anymore. When, it was all like Tesla's a tech company, GM and Ford make cars. So once they get into the EV thing, it's going to totally change the game because they know how to churn out these suckers and do it for cheap.
Right. And here's the thing, though, Alex, is that when you look at the, call it competitive advantage of a legacy automaker, is that if the timing isn't right to ramp your EV production or this new technology, you still have the old school internal combustion vehicles that are extremely profitable that you can lean on in this kind of macro environment. And to give you an example, everybody talked about Tesla cutting prices and inciting a price war amongst all the automakers. And Ford cut the price of Mustang Mach-E. So one automaker cut the price of one electric vehicle in response to Tesla. And I would argue it wasn't in response to Tesla. It was because they had too many units. But if you look at Mustang Mach-E production, the first 2 months of 2022, last year, they built 10,000 units. In the first 2 months of this year, 2023, they built 360, right? Not because they forgot how to build them, right? But because they can't sell them profitably. So Ford is a company who says, we're going to do less of that. And hey, look, if F-150 Lightning is selling well at $82,000 profitably, we'll do more of those, or we'll sell regular internal combustion F-150s until we ride out this macroeconomic environment. The problem is EV adoption is going to be very slow because of that.
Kevin, if I look at Tesla equity FA on the terminal, I see an EBITDA margin of roughly 20%. Is that a real margin?
Well, here's the thing. Two things you have to remember and I think this is something that happens almost every quarter with Tesla, is that in that revenue line there's regulatory credit sales, which are reasonably easy to back out of there. The other thing that they do is they'll release deferred revenue from that full self-driving technology. And I can't get a real clear call on when the cost associated with that revenue is booked. So what you have is, let's say a quarter like this one coming up, there's price cuts, there's demand issues. I feel like Tesla's the kind of company that will direct your eye to their gross margin because they've added in this additional revenue, of which there's very little cost associated. It's certainly not in their cost of goods. So they're the kind of company who can say, yeah, price cuts and volume was down, but look at our gross margin. It's so much better than everybody else's. We can afford these price cuts. But that's not margin coming from what it costs them to build something versus what they can sell it for. It's this sort of extra revenue that they got in the back pocket that they sort of flow into the top line as they need it.
What part of this also, though, is the IRA? Like, couldn't we make the argument that Tesla cut prices because they needed to cut prices to get IRA tax credits for EVs, and that's what kind of incited all of this, and it's just going to take a while for that to feed through into the market for consumers?
Yeah, I feel like, though, when are you cutting prices from a position of power? Yeah, you get some models in IRA, but Ford, GM, and Tesla are the only ones that have. There was $7,500 federal tax credits for years and years, and we're still 3% EV penetration. So, and that assumes that the consumer knows or understands what they're getting, what's eligible. So there's a lot of noise around IRA to the point where obviously this is not about EV adoption. It's not about climate. Otherwise, everything would be eligible. There's a little bit more going on with IRA than simply let's drive sales for Tesla or GM or Ford.
What percentage of cars purchased in, 2030, do you think, Kevin, will be EVs in this country?
Well, let's just say I think it has to happen, right? I think while there's a lot of issues with EV, I think it has to happen because not only is there a lot of money being invested in this by the manufacturers, there's no other growth driver on the horizon. And what I mean is this market, the U.S. market, is relatively flat, somewhere below 17 million units. Let's call it 15. And we can't break above that 17. So we're not growing as a market in terms of unit volume. We've already shifted mix to 80% truck from 20. So you have automakers like Ford and GM who are 90% truck already. So where do you go? Well, your next mix shift or revenue shift has to come from this new technology.
All right, our thanks to Bloomberg Intelligence senior analyst Kevin Tynan.
You're listening to the Bloomberg Intelligence Podcast. Catch the program Saturdays at noon Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, software and app makers are seeing a bit of a slowdown in sales and growth, and we're going to find out why and how regional bank turmoil actually might be part of it. We're going to break that down with Bloomberg Intelligence senior analyst Niraj Patel. Wait, am I relating like SVB with software and apps? What is the line there?
Yes, there is a connection. It seems that, finance is the big buyer for software, 23% share of software spend in the U.S., and the regional banking crisis has kind of a double whammy effect on the software spending. We look at it from one side where you have tighter credit availability for small and medium businesses, and they account for about 38% of the software spend. And this is going to limit the discretionary spending that's covering most of tech budgets for SMBs. And then on the other foot, you have the finance sector, includes the banks, insurance firms, security firms, and they are the biggest buyers in the U.S., and we have maybe an impact from the regional banks. We looked at SVB tech spending recently, and they were about $100 million in 2022. And when we compare that to the best in the class, Goldman Sachs, that's about a 40% compare of Goldman Sachs dollar growth in spend, with only being 15% of the revenue level. So yes, definite impact here.
This might be one of the more cautious discussions I've had with a software analyst in 20 years.
What's that?
You never hear software analysts talking about softness, business slowing. It's just everything's to the moon here. So Niraj, given your research, how long does this cycle, if it is a cycle, how long does it typically last?
Yeah, I think software has been typically spoken from a positive view just because of the growth. When you're looking at zero GDP growth, you're looking at 4% kind of baseline software growth. So we are looking at a couple different reasons why we've had this overshoot. The pandemic, everybody understands, but when you look at the numbers, you had 8.6% growth in 2020 when you had a negative 2% GDP. Last time you had a negative 2% GDP, you had 1% spend in software. That was followed up in 2021 with 13%, in 2022, 14% growth in U.S. software spend. And the 15-year average is 9%. So above average, we have a below average period that's taking place right now in this year and the next year. So we think 2023 and 2024 are below average growth to get back to average.
Okay, so this is just normalization then. This is not a different slowdown.
So that is normalization per accelerated spending during the pandemic.
Right, so it's like going back to like 2019, 2018 kind of spend then.
That's correct. But post-pandemic also, the remote from work, that has accelerated a lot of app proliferation across businesses. There's just an oversupply of apps. So you may have 350 apps in an average business in the U.S. with a utilization of about 40%. So we think this has led into an oversupply of software vendors, whether it's on the HR side, payroll side, or the sales and marketing side. So that's going to take a little bit of consolidation and time for that to contract to a reasonable supplier base. So that's another aspect. And what we're seeing, the breadth is spreading across categories. The weakness is reaching from computer-aided design all the way to supply chain to procurement. It's not deepening, but it's just extending.
So within your coverage, Niraj, is there any companies that kind of stand out either one way or the other here as we enter into a slower period of growth?
Yeah, entering 2023, we were really calling for outperformance among app software peers in the HCM, the HR and payroll software area. And our view is this is going to continue to outperform specifically the companies like Paylocity, Paycom, Ceridian on a revenue growth expectations, primarily driven by the small, medium business net positive hiring and their pricing leverage. They're moving from payroll modules to time and attendance tracking. It's giving them a pricing lift to their customer base, which is in the earlier innings. That compares to the larger enterprise companies where they don't have as much room and there's a lot more competition. So those companies look favorable in our view, and they're 20% plus revenue growth or growers for this year.
Are they also going to be the buyers if there's some M&A?
We think there's consolidation among these players because there's just too many players across small, medium business, mid-market, and enterprise in this area. We think that plays out. Once you have the net positive labor market picture turn and maybe loosen a little bit, then you will not have the customer addition growth rate, which is one of the pillars for growth for these companies. So they will be consolidated, we think, as well.
So, Niraj, what percentage of the company's app software makers, how much of their revenue is kind of recurring revenue, or I got to go out and hustle for it every year?
For the app software makers, we're looking at about a 90% recurring revenue.
Nice.
That's at the large customer. When you get to the smaller customer, they are hustling every month because the contracts are not 3 to 5 year type of terms. These are month to month in some cases.
How closely does this sector follow small businesses? Because obviously like the big guys are always going to be spending on tech, right? But the small businesses are going to be the ones that are going to be hurt most by any fallout from SVB and lending standards tightening. And they're going to feel it the most. They're already feeling a credit crunch. What's the correlation there?
So there's a very strong correlation, and a lot of analysts don't dive into the SMB segment for tech spending because a lot of the infrastructure tech spending is biased to large organizations, the plus 1,000 employee type of company size. But when we look at app software, 38% of the budget is spent by SMB companies, less than 1,000 employees. The correlation is following very closely to some of the business indicators. We looked at, we like to look at a lot of cross-section of data, whether it's Census Bureau, Fiserv, spend trend data, the NFIB survey data, and they started moving off peak levels in 1Q 2022. That matched fairly close to peak revenue growth rates for the SMB applications software providers.
If sales are slowing down here, does that go right to the margin, or are there things these companies can do to reduce expenses in line?
Yeah, and I think this is why a lot of the investor community favors this sector, even when there's a top-line slowdown. When you're looking at a business profile, about 85% gross margin, they have 15% operating margin, and that leaves them with about 45% of sales they're spending on sales and marketing. That can be tuned back. So that's a significant expenditure, which is quite controllable from their levers.
All right, thanks a lot. We super appreciate it. It was something that neither of us expected to hear, I have to be honest. Niraj Patel, Bloomberg Intelligence senior analyst, joining us. From an area in tech that's slowing down to one that looks like it's ramping up, you got Intuitive Surgical. That's a firm that makes robotic-assisted surgical products. Could see 20% growth this year, topping estimates. For more, we want to welcome Bloomberg Intelligence healthcare analyst Matthew Henriksson. So, Matt, just in general, big sweeps, Intuitive Surgical, give me some examples, real-time life examples of how this stuff is used in real life.
Yeah, sure. So the robotic systems that Intuitive makes, the Da Vinci system, it's used for many different indications for general surgery. There's hernia repair, there's
like appendicitis.
Yeah, exactly. Appendicitis, bariatric surgery.
It's like a robot with lots of arms that gets in you.
Exactly.
Mm-hmm.
So what it does is that instead of having an open surgery, you have smaller incisions and you use those robotic arms and the camera within the system to help with the surgery to either repair or to remove any harmful devices in there.
Man, this is a big company. It's got a $94 billion market cap.
Yeah.
All right. Just tell me about the company, because I have known nothing about this. What's their business? Just give me the elevator pitch.
Yeah, so it's their Da Vinci robot system.
Da Vinci robot system.
And basically what it is, it's a monopoly of robotic systems. So when you think about globally, there's 40 to 50 million surgeries done each year across the world. less than half of those, 40%, let's say, are done minimally invasive. So some smaller incision. It's not an open surgery. And then the rest of it that is done robotically. So you have maybe 5 or 6% that's done robotically. That's all Da Vinci. There's no competitors out there.
Really?
Yeah. And so, and that's where the opportunity comes for them to really kind of get this, the foot in the door to try to really gain and market opportunity here.
Coming up next, more with Bloomberg Intelligence healthcare analyst Matthew Henriksson on growth in healthcare tech.
You are listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us Saturdays at noon Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Let's dive back into our conversation on healthcare tech with Bloomberg Intelligence healthcare analyst Matt Henriksson. You got Intuitive Surgical, that's a firm that makes robotic-assisted surgical products, could see 20% growth this year, topping estimates. So if you see 20% growth, how much of that is like surgeries from COVID that got delayed that's like playing catch-up versus like new growth in surgeries kind of thing?
I think we're past the backlog perspective. There was always that conversation going on about what's in the backlog, how's that going to accelerate growth. I think we're past that. I think now we're 3 years in. I think we're now looking back at what the opportunity is, what the run rate is. The bigger issue actually is staffing shortages. And so there's sometimes there's fewer doctors than are needed. The nursing staffing shortage was a big component. And so what you can do with robotics potentially is if you have robotic arms, you don't need nurse arms. You don't need an extra pair of surgeon arms to help out with the open surgery. And by doing that, that allows the surgeons who are in the hospital to be able to do more procedures over time, where you would have, let's say, 4 surgeons doing one procedure. You could have 2 surgeons doing a robotic procedure, and then the other 2 are also doing a similar. So you're seeing that kind of utilization pick up because you need less staff to kind of run these systems.
I see in your research note, recurring revenue rose to 79% of their revenue. How is it recurring? How does that model work?
So there's two components to the recurring revenue stream. So you have the robot, you have the capital placement itself. But you have then these instruments. And so these are cutting instruments. These are stapling instruments. These are, they could be heat to ablate certain cells in the body. Using those instruments, you can only use those 10 to 12 times, and then you have to buy new ones. So that's the recurring one. The other shift that's going on here is that these capital placements, they're $2 million purchases for these hospitals. And they're now becoming leasing programs. So you lease them out for 7 years. And so that they're considering that recurring because every year you have 1/7 of the capital price versus just one outright purchase.
In terms of what the stock has factored in, I feel like medtech and life sciences has already been so popular with literally anyone. How much more upside can there be with the stock?
It's definitely... It's interesting because it's medtech and life sciences. It combines both like innovation of technology and kind of the stable safe havens because people are still going to get sick regardless of what the economy does. There's a shift. One of the biggest components is actually just the aging population. As the baby boomers get older, they're going to have more ailments. 2, they're going to be covered.
Don't upset Paul.
I won't tell anyone. But with Medicare, they're going to be covered regardless. And so there are going to be more procedures that get covered. So that helps kind of the momentum going. And then just from here on out, it's going to how you differentiate yourself. And one of the things that Intuitive is out in front of is this robotic momentum.
All right, just real quick, I look at the ANR function on the terminal. 15 buy ratings, 11 hold ratings. Kind of split out there on the street.
It is. I think... It's expensive stock. You're seeing the PE ratio, right? It's ranging around 40 times. And so when you see that type of multiple, you have to have the revenue growth to be able to support that. I think this early in the year, there's questions about what potentially is the procedural growth volume for this company, especially after a rock solid year in 2022. But that could potentially have some upside there if they're able to continue to kind of beat consensus, beat their guidance, and be able to do a beat and raise each quarter. So
great stuff. Thank you so much, Matt. Appreciate it. Matt Henriksson, Bloomberg Intelligence healthcare analyst.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney, and this is Bloomberg.